If you're a first-time home buyer or in the market of buying your first home, you want to listen to this video because today I'm going to talk about the limited tax benefits currently available to you today. So listen up. Hi, I'm Erica with Paragon Accountants, and one of the largest misconceptions with first-time home buyers is an outdated belief on the tax codes relative to first-time home buying. Today I'm going to break down the good and the bad about first-time home ownership and what you can be eligible to take as a tax deduction against your federal income taxes. So let's start with the bad news. There have been 3 big changes to the tax code that reduce the tax deduction for home ownership. Number 1, an increase in standard deduction. The Tax Cuts and Jobs Act passed in 2017 eliminated or limited many deductions and credits. So while you used to be able to itemize parts of the cost of your house as a deduction, many of our clients are now taking the standard deduction. 2, the SALT cap for property taxes. SALT, short for state and local taxes, is an attempt to address the wide gaps in the levels of taxation from state to state. Prior to the 2018 tax year, taxpayers could deduct unlimited amount of state and local taxes on their federal returns. From 2018 on, the SALT deduction is capped at $10,000 for a single taxpayer, $10,000 for a married filing joint couple, and $5,000 for a married taxpayer filing separately. What does that mean for you as a first-time home buyer? That means that your property taxes most likely will not be eligible for itemized deduction, a potentially big hit for people in states with high income tax and property taxes. Mortgage interest deduction is our 3rd limitation. You used to be able to deduct the interest on your mortgage up to $1 million. This still applies to mortgages originated before December 16, 2017, but anything after that has a $750,000 loan-to-value limit, or $375,000 if you're married and filing separate. That $250,000 difference can really add up in states like New York or California, where the entry-level home price are extremely high. It's also important to note that you can only take the mortgage interest deduction if you file a Schedule A and itemize. The change does not matter to people who take the standard deduction, which many of you do. The good news is there are still ways your tax professional can help you maximize your deduction. One of the most hot topics today is the Biden First-Time Homebuyer Act. Now, as of this filming, it's still not law, but it is a current bill that is most likely to become law. And if that passes, first-time homebuyers can get a tax credit of 10% of their home purchase price up to $15,000. As of now, the requirements are as follows. Make no more than 160% of your area's average median income. 2, you must be a first-time home buyer or have not owned a home in the last 3 years. And 3rd, you must occupy the property as your primary residence for a minimum of 4 years. Just remember, this is still a bill and has not passed into law. So make sure your tax professional is up on the most current laws so that you can maximize your deductions. So to recap, while there are less deductions you can make as a first-time home buyer, there are still options out there for you. Meet with your tax professional regularly, not just as a tax season once a year, but to maximize your deductions throughout the year. If you found this video educational and helpful, and you or your friends are in the market to buy your first home, please subscribe for more helpful tips, share us, like us, and we look forward to seeing you soon.